Welcome to today's panel discussion on private equity and venture capital investing in Southeast Asia and broader Asia. My name is John Tang. I'm a managing director with the private equity group at GIC. And I'm very happy to be a moderator today, especially given that we have a very experienced panel of market practitioners with us here today. So let me introduce them first. Firstly, on my left, we have Mr. Kenny Ho, who is head of investments for Alibaba in Southeast Asia and in India. Okay. Now, Alibaba obviously needs no introduction. And Kenny has led investments for Alibaba in well-known companies, and you guys all know this because you do your shopping there, in Lazada, in Tokopedia, and Paytm in India. Since joining Alibaba in 2010, Kenny has also been involved with the huge IPO of Alibaba in 2014. And by the way, congratulations, Kenny, for Alibaba's $30 billion sales record for Singles Day, right? Then on his left is my former colleague, Mr. Meng, who is head of private equity for Asia Pacific. I won't try to pronounce for CDPQ, and I won't try to pronounce what CDPQ is because it's in French. But it's the second largest pension fund in Canada, and one of the 10 largest private equity investors in the world. Okay, it's got a huge private equity portfolio, and they actually do quite a bit of direct investments in companies as well. Based in Singapore, Meng actually started his career at GIC, where he was head of Greater China. He has more than 20 years investing experience in China and in Southeast Asia. And previously, he was also head of Greater China and Southeast Asia for Actis Private Equity. And last but not least, we have Rajeev Natarajan, who is head of Asia for Iconiq Capital. Now, for those of you who may not be as familiar, Iconiq Capital is a private investment firm serving some of the world's most influential and rich families and organizations. It has offices in San Francisco, Palo Alto, New York, and Singapore. And Rajeev was a former banker. He joined Iconiq in 2016, and he has led investments in Asia's leading sports media property company, and has also helped the global leader in life cycle management technology, a company called Braze, expand into Asia Pacific via Singapore. I will also say a few words about GIC's private equity practice, which I've been in for the last 18 years since I joined GIC. Now, as I hope all of you know, or at least most of you know, that the GIC is Singapore's sovereign wealth fund. And in the area of private equity and venture capital, we are one of the earliest and probably one of the largest private equity investors in the world today. We invest out of 7 offices around the world, and we invest both in funds as well as directly into companies. In the area of technology, we actually have a very strong platform. We have a very good portfolio of some of the top venture capital firms and fund managers out from Silicon Valley and in China. And we have had the good fortune of investing in some pretty great tech companies in the past, including Cisco Systems, Alibaba, Ant Financial, Xiaomi, and Meituan Tianping, etc., etc. Okay? So that's for our background. Welcome, folks, gentlemen, for being on this panel. Match is a new initiative, right, by the MAS that aims to matchmake ASEAN startups with potential investors like yourselves. So I'm sure your views today will be very helpful to some of the entrepreneurs and executives in this audience today here. But before we start talking about ASEAN, would be good as a warm-up to maybe step back and reflect a little bit on private equity in Asia in general, right? Just to provide a sort of bit of a background, how that has evolved and what parallels we can draw with regards to Southeast Asia. Now, Meng, you probably have the longest investing track record here, so I'll start with you first. The Asia PE market is about $160 billion today, and that's 3 times the size of what it was just 10 years ago. And half of that probably is China, right? So could you share with us your early experiences in China and how that market has evolved?
Sure, thank you, John. China's private equity market has certainly come a long way. I was posted by GIC to China in 2003, and the year before, the total transaction volume in China private equity market was only less than 1 billion. And last year, it was 73 billion. Just think of the growth of the market. So what propelled this growth, right? I think it boils down to one word: the acceptance of, among the private entrepreneurs of private equity money. So what happened? When private equity first started in China in the late 90s, all the PE shops, including GIC, were targeting only the private entrepreneurs. And the reasons were obvious, right? Now, they have no access to bank credit. The IPO window were not open to them. And a lot of these private entrepreneurs in China, they have this fear about, their property rights are not protected and Cultural Revolution could one day resurface and so on. So they wanted to find a way to sort of IPO the company in Hong Kong, in the US, and so on. And that provided the role for the PE shops where they can use the red chip and VIE structure to help this company achieve the aim of IPO in Hong Kong or in the US. Now, even then, the market has grown very slowly. I remember in 2002, traveling across China, I still get asked all these questions by entrepreneurs. What is debt? What is equity? What is the difference? And what is private? And so on. But, the inflection point came in 2004. That was the year when Li Ning, Meng got listed, Tencent also got listed. And all across China, entrepreneurs took up and noticed that these companies got funded by private equity and they got listed, and all these founders became very wealthy. So immediately, people started to accept private equity, and today, it is very rare to find entrepreneurs that will reject private equity. In fact, they are so smart, they compare notes, they educate each other, and they even train each other how to seek out and how to negotiate against the PE guys. So market acceptance of PE has propelled the growth in the China market. I would say that that's the same thing for the buyout market. When I moved over from GIC to Actis in 2007, 2008. I was trying to do mid-market buyout. All the LPs were very skeptical, and even some of the GPs were very skeptical. People have this mindset that to the Chinese, family businesses are meant to be passed down from generation to generation. But the Chinese have such an open mindset, and they have the succession issues and so on. And today, buyout is about 30% of the total private equity market. And the same goes for the venture startup VC space. About 5 years ago, it was still a tiny portion of the overall market. And today, VC startup deals easily account for 50% of the total 73 billion that we talked about. And today, China has more unicorns than the US, and some of the top unicorns have market valuation that is greater than the counterparts in the US. So this is certainly a very exciting time in China. And I would say that, in addition to this, another phenomenon that is happening in China is that China is inventing business models. Back in some old days, there's this term called C2C. It didn't mean consumer to consumer. It meant copy to China. So you had Google's, and then you had Baidu. You had Groupon, you had Meituan. But today, the Chinese startups are reinventing some of the business models. Think about Mobike, think about Pinduoduo, and so on and so forth. So I think this is certainly very exciting, and that provides a lot of inspiration to these entrepreneurs in Southeast Asia and other Asian markets.
Okay, thanks, Meng. I'm going to ask you to, sort of make that connection later to Southeast Asia. Maybe we have a C to S, right? China to Southeast Asia. Yeah. But before that, let me get to Rajeev. Iconiq is a very well-known tech investor in the Silicon Valley, and I want to talk about Sequoia Capital's Mike Moritz, right? He said Silicon Valley would be wise to follow China's lead. And I think he meant that from a cultural standpoint. But one can argue that actually China is leapfrogging the US in certain areas of technology. So try to bring it a little bit back to technology. Rajeev, maybe you can talk a little bit about Silicon Valley versus China, and then later we can get into Southeast Asia.
Sure. Just to clarify on Moritz, I think his comment was intended at describing the differences from a work ethic and sort of cultural ethos perspective. And obviously it created some controversy, but in China what's very apparent to us is it's very difficult to compete with organizations that have this 996 culture, 9 a.m. to 9 p.m., 6 days a week, where there is no work-life balance, it's work-life integration. And what we see in the US, particularly from very scaled businesses, very mature technology companies, is if you go to these campuses, they often look like professional Disneyland in many instances. And so I think that was his point, but obviously it was quite controversial when he said it. To answer your question on the similarities and the differences from an investing ecosystem perspective, the similarities I think between the US, Silicon Valley, and China are very obvious. Each exhibit very large total addressable markets, relatively homogeneous demographics, ability to scale with capital and capital efficiency, and frankly an ability to create monopolistic businesses. So it's no surprise to us that you see acronyms like FANG and BAT in those two markets. But I think that's where, from our perspective, the similarities really stop and the differences start. And I think those differences are quite stark. For one, China has had a very consumer-oriented history from a technology perspective. We find the US has been a lot more versatile, a lot more diversified from an investment opportunity perspective. So whilst there are a huge number of consumer opportunities in the US, it's also supplemented, at least in the last 5 to 7 years, with a huge amount of opportunity in enterprise, huge amount of opportunity in infrastructure, in cloud, in governance, and security. Some of those sectors we feel, until very recently, haven't been pronounced in China yet. China has largely been a consumption story. So I think that's one main difference for us. The second main difference, I think, has really been, and it's perhaps a little extreme for me to say this, but China is essentially, for us, feels like a closed market. Closed market in the sense that unless you have very specific material onshore relationships and partnerships, we feel it's very difficult to succeed and to understand local nuances, cultural dynamics, language, currency, regulatory paradigm, and be able to scale a business. I mean, the obvious statistic is when you see Chinese nationals, Australian nationals, Southeast Asian nationals or Europeans go to the US and start companies, we feel that they have equal opportunity to succeed. I think the challenge in China is if you're a foreign national looking to set up a company in China, we think the cards are not always stacked in your favor. And so one of the big challenges for us is who do we partner with in China to invest in a way where we feel we can genuinely exploit competitive advantage. And so China for us has largely been consumption-led, and we hope will evolve to a more enterprise-oriented ecosystem, which I think will be amazing for the jurisdiction. And two, the ability to disintermediate local partners over time and feel comfortable that you can invest directly into the market. I think will be very, very progressive for China.
Okay, great. Well, let me try to bring it closer to home now. Kenny, so Alibaba has gone from being a household name in China to a global powerhouse, right? Expanding into other Asian markets and also into new verticals, like fintech and new retail. Help us understand the journey that Alibaba took in this direction, and how does it connect with Southeast Asia and with India, which are the markets that you oversee?
Sure. From an investment point of view at Alibaba, we only focus on strategic investment, and by that I mean investments that will sort of help support our existing business to diversify, sort of the asset base that we have to serve different customer needs. So Alibaba is a very, I guess, if you were to sort of look at Alibaba's mission statement, is to make it easy to do business anywhere, right? So, that is sort of the, Jack Ma's vision from day one, and something that we still focus very closely on in terms of, making strategic decisions. And I get the investments kind of follow that as well. So I guess, from a business point of view, we serve, we sort of take a three-pronged approach to serve our customers. So we have our core commerce business, we have entertainment, and we also have local services, right? So, from an investment point of view, it's about strengthening ability through investments to offer services and products to people along these lines, right? So, in the past, you've seen us, make investments or partnerships with Suning, which is sort of the earliest version of what we now call new retail. And then you've seen more recently, we've done deals like, with RT Mart, the hypermart chain in China. In entertainment, we have Youku, which is sort of the YouTube-like product that we have in China. And then local services, we have food delivery company, local food delivery company called Alibaba, right? So. And it's, the way we kind of see it, it's kind of like a game of Go, right? You kind of put all the pieces together in the chessboard and see, and sort of figure out a way to see how they kind of work together. But then I guess one important point is also, after sort of putting all the pieces on the chessboard, right? Strategic investment is about how you make them, how you connect them so that they be able to sort of generate synergies. So that's kind of a little bit of what we're doing in China. And then in Southeast Asia and in India, I guess the markets for us are a lot more early stage, because you look at the biggest market in Southeast Asia, Indonesia, right? In e-commerce GMV, I mean, depending on what estimate you're looking at, it's probably somewhere between $20 to $30 billion, right? And you look I guess on a pan-regional basis, probably about high 30s to to 40 billion, and that compares to $1 trillion of GMV in China, right? So we're like 3-4% in, and then there's definitely a lot of room to grow and a lot of I guess a lot of potential, I guess, for us to come in and apply our experience and technology to serve consumers in the region. And then sort of bringing it back to investment, right? How do we do investments to help us serve more customers in the region? You've seen us invest in companies like Lazada and Tokopedia, which are sort of the platforms that provide e-commerce, the basic e-commerce service. And then, Lazada is sort of a wholly owned subsidiary. It's more or less works like a wholly owned subsidiary now. Tokopedia is more a portfolio company. These are sort of the basic building blocks that we have to put in the market to enable us to serve customers, right? And then, if you were to take a look at the journey that we've taken in China, we have also, used investments to sort of build built out various areas that are important to a core, operations, like logistics is one area, payment, as you mentioned earlier, is also another area. So I think this is sort of the direction that we're taking. We're still in very early innings in the market, and there's definitely a lot more to do.
So I have one question here, which is not in the script, right? And it regards Alibaba's ability to, well, basically, you are a kingmaker of sorts, right? There are a couple investors out there, one of your competitors, the Vision Fund. They're large enough to be kingmakers when you invest in a company. And maybe I put this question to Rajeev here, so give him a few seconds to prepare. But basically, if one of your portfolio companies, and I think that, for those out there in the audience, if you are fortunate enough to get an offer from Alibaba, what do you say? Can you say no to Alibaba? If you say no to Alibaba, then won't Alibaba just go build it rather than buy it? And then what happens to you? So, Rajeev, what would you tell your entrepreneurs if they get an offer from Alibaba?
I'm not. I think you're addressing that to the wrong person. It should be this guy.
I'm going to ask him that later too.
No, I think as an entrepreneur, you make the same decision as you make from a capital raising perspective. You make a determination as to who the right partners are for your company, what stage of evolution you are in the business, and whether or not taking capital is a gun to your head from a certain partner, or it's an enabler that allows you to compete with conviction and win the market quickly. And I think that inflection point for every startup and founder is the most interesting inflection point, and the capital partnership should dictate that. I think Alibaba, Tencent, who have had very large strategic investments in Southeast Asia, have been incredibly powerful for the ecosystem and been very progressive for the ecosystem. So net-net, they've been very beneficial. But to the extent that you feel as a founder that you potentially lose control of your vision, your strategy, your direction, and your execution ability, and then at that point, I think you've got to figure out what your trade-off is between capital and your own vision being compromised. But in general, I think it's a positive step forward to have large conglomerates that have done this before make strategic investments like this.
And Kenny, what's your...
Yeah, I agree with what Rajeev just mentioned, but I guess from our point of view, we sort of see investment as a sort of a partnership with entrepreneurs, right? In areas that we might not necessarily have the expertise, experience in, and then whenever we consider a strategic investment, we need to have a very detailed plan to figure out what we're going to do. It's not just capital investment. It's also about providing with portfolio companies with resources, technology, and know-how to help it do things better, right? So I guess in addition to benefit our own business, the portfolio companies that would also benefit from I guess this partnership, and it's sort of under this philosophy that we invest in I guess entrepreneurs. So it's sort of a mutual relationship to us.
Okay. Maybe let's get a little bit more into Southeast Asia. Southeast Asia is a 600 million population, and actually a per capita GDP that's actually twice that of India. But one could argue that the penetration of private equity and venture capital in Southeast Asia is actually underpenetrated, right? So let me ask Meng An, you know this market very well. Why is that the case? What are the challenges with relation to Southeast Asia? And also maybe, what opportunities then are you, CDPQ, seeking in Southeast Asia?
Okay. John, you are right. If you look at the transaction volume of Southeast Asia private equity, since 2012 to 2016, it's pretty much hovering around 6 to 8 billion a year. It's pretty much stagnant. Last year it went up to 20 billion, mostly because of some multi-billion transaction, but a lot of people don't see this as staying at that level. So to your question, when China has grown by so much, why has Southeast Asian private equity volume not grown at all? And I think there are a couple of reasons for this. Number one is that, it is not a homogeneous market. A lot of these countries, the level of integration among the ASEAN countries is still very, very low. And each of these countries are still limited in size of the domestic market and GDPs and so on. So you don't find companies that can scale up as rapidly as they have in China or India, right? So that's number one reason. But the more important reason, I think, just drawing the lessons from the China private equity market's growth is that the acceptance of entrepreneurs about private equity is still somewhat not at the same level. So I'm still waiting for that inflection point, as I talk about in China's, that to happen in this part of the world. So I think there's some positive signs, so with the growth of 6 to 8 billion to 20 billion, one of the biggest transactions last year was definitely Grab, that raised about 2.5 billion, and recently, Gojek has been raising a number of rounds. So I think that are positive examples, and I hope the demonstration effect can set in. The other, point about the acceptance of private entrepreneurs about private equity is that the buyout market somehow also has not taken off, right? When people look at Southeast Asia, it's very, very different from China. There have been a long history of private entrepreneurship and lots of business, family businesses and so on. And it has become like a norm in this part of the world that family businesses are meant to be passed down from generation to generation. Whereas in China, that has not been the case. The history of private entrepreneurship has been relatively short for the last 30, 40 years. And people didn't have this preconceived notion that family businesses need to be passed down from generation to generation. So that, I think, is a big impediment to the acceptance of PE. And last but not least, if you look at the different markets within Southeast Asia, Singapore, Malaysia, Indonesia have been like the most active market consistently. And if you look at countries like Thailand, Philippines, I mean, the GDP growth, especially the Philippines, has been very strong, and Thailand sort of turned the corners and respectable, and they have sizable economy. So why haven't private equity taken root in these two countries? And I think the key reasons for that is that the economies in those markets tend to be dominated by family conglomerates, and the level of M&A activities in these two countries are comparable to other Southeast Asian markets. But whenever there are deals, they tend to be done by the family conglomerates among themselves and leaving very few opportunities to private equity. So I would say all of these reasons contributed to the lack of growth in the Southeast Asia private equity market.
Wow, that's kind of discouraging. So if you're not born in a rich family, and you're kind of, then you have to study a bit harder, I guess, right? That's the only way out. But maybe get another view here. Rajeev, right? Iconiq, you folks have made a couple of investments, right? Maybe a little bit more earlier stage, and maybe that's the answer, I don't know. But maybe shed some light on what you've done. Why have you done those opportunities? What are you looking for? Maybe be a little bit more optimistic.
I'm not sure I can be super optimistic because I concur a lot with what Meng said. I think the jurisdictional complexity in Southeast Asia is a material challenge. You mentioned 600 million people, nine individual countries, but frankly, what works in Singapore doesn't work in Hong Kong. What works in Hong Kong doesn't work in Jakarta and Bangkok and so forth. And so, the number of pitch books we see every month from aspiring founders who have page 2 of the deck will have a map of Indonesia, and on that map of the archipelago it'll show a number of 230 million customers as their addressable market. And often the question isn't really, is it 230 million? The question is, can you genuinely capture 3 million in central Jakarta? That's more the question. And then the question isn't really, is it 230 million or 3 million? How do you get from 3 to 6 million? And how achievable is that? And so I think there is the Southeast Asian ecosystem is vibrant. It's particularly vibrant early, but what we've observed is they get to a certain phase of their evolution. They get to a phase of their funding market ecosystem, and then they either tend to tap out, or in certain situations, Grab, Gojek, etc., they're so incredibly well funded, their businesses are able to transcend borders and they are able to scale. But those examples are few and far between, given the size of the addressable market. For us, there have been a couple of examples. One is a recent sort of North Asian example, and I mentioned earlier in China, one of the challenges of not having local partners, or how difficult it is to make investments from outside of China and not be hyper-localized. And so that's partly the reason we invested in a very well-known music streaming company in China. It's the market-leading and incumbent in music streaming, an equivalent of sort of Apple Music or Spotify. And it was evident to us very early in that dialogue that the cultural nuances of acquiring content, negotiating rights with artists, managing the supply chain, understanding what Chinese consumers wanted to consume from a music and entertainment perspective was incredibly Chinese-centric. And so the competitive moats around China gave us a lot of conviction that this particular company has 85% market share, and it has over 550 million unique users, that game in general is done. And so it's really scale and execution from here, and unit economics, etc. So that was one example of an investment we made relatively recently, but in an environment where we felt really comfortable that the risk reward for us was asymmetric in our favor. The Southeast Asian example is a little bit more nuanced. You mentioned at the start a mixed martial arts sports media asset, which we were very fortunate to participate in. Part of the interesting aspect of this particular genre is that the genre of sports is largely universal. So in some ways, the heterogeneous nature of Southeast Asia naturally becomes homogeneous when you're engaging with consumers in the area of sports. And the genre of mixed martial arts is particularly interesting because it essentially is a convergence between professional boxing, which has been around for hundreds of years, and more theatrical genres like wrestling, which has also been around for a long time. And that convergence in Southeast Asia is very scalable. So that's kind of one point as to why we were able to bridge heterogeneity with homogeneous aspects of this business. The second part of it was the way content is being aggregated and disseminated around the region. Most people consume content either on a value where it's valued on when it's live, or in formats in small 3 to 5 minute ingestible bites. Young people today do not want to consume content that's longer than that. And so if you take a sports media asset like that can either be delivered live or delivered in small ingestible bites, in non-traditional formats, you have a much more scalable, universally accepted content distribution business. And so that hopefully gives you an example of comparing and contrast how we differentiate between making an investment in China and how we differentiate between making an investment here in Southeast Asia.
Okay. Yeah, maybe I'm going to come to Kenny here, but I'm going to ask the question in a different way with respect to Southeast Asia. Because if I look at the successes so far in Southeast Asia, Grab, Tokopedia, Lazada, these are, I for lack of a better word, maybe you can call it more softer tech. It's more about online shopping. It's more social in nature. Ride sharing is also kind of a social activity, and then your sports company. That's sports has universal appeal, right? So that's your point. That it compensates for the lack of heterogeneity, right? So Kenny, Alibaba has all that, but you guys are also players in what we call hard tech, right? So if you look at the hard tech spaces, the AI, the fintechs, the cryptocurrencies, the blockchains, the SaaS, the clouds, once the play for all the online shopping and ride sharing and all these sports, more social in nature, companies are kind of being acquired, or the winners are already clear, then what will Alibaba be looking for, right, in terms of Southeast Asia companies that maybe could be a bit harder tech or higher tech, or which part of your value chain that you're looking for that you could, sort of find companies with technology?
So I would sort of look at this question through two angles. So from sort of the headline investments that you mentioned, I think there are not too many of them. Yes. I guess, right? But then I think if you sort of take the view of an overall ecosystem, right? I mean, the ecosystem is made up of a lot of like smaller companies, and I think to sort of get the ecosystem up and running, a lot of focus would be on how to sort of support these smaller companies so that they could sort of serve whether it's the merchants that's selling on Lazada or Tokopedia, or participate in the value chain of procuring products from sellers to buyers, right? So there's a very long value chain, whether you're talking about fulfillment, logistics, sourcing and all that. So I think there's still a lot of work to be done. And like I said, I think e-commerce itself in the region is still at a very early stage. And a lot of offline companies that want to go online still lack the capability to operate an online operation. So I think the potential for these companies to scale up and help bring offline players to online is a big opportunity. Now back to the sort of the hardcore tech question. Alibaba itself is an infrastructure company as well, right? I mean, Alibaba Cloud was born out of the need to handle massive amount of data from Taobao like 10 years ago, right? And then in Southeast Asia, I guess once you sort of reach a certain scale, right, companies would then need to sort of handle their data, whether it's sort of data management, storage, analytics, and all that, right? They're going to need a cheaper solution that will help them handle these issues more economically. And I think at that point, then you're going to see a lot of a higher level of adoption of, let's say, things like cloud computing and SaaS products. Happening across the region. I guess it's a lot of like players like Amazon, AWS, and Google Cloud and ourselves are already in the market. But I guess you're going to see a big wave of growth in the future.
Okay, that's helpful. I wanted to maybe reference back to technology in China, and maybe in the space of artificial intelligence, and kind of relate that back to Southeast Asia, right? So there's a thinking now that artificial intelligence, the ingredient for artificial intelligence is a good algorithm like DeepMind, but what you also need is a lot of data, right? Because so data is the new oil, right? And China is the new Saudi Arabia, right? If you can, relate to that, right? So by definition, if you actually believe in that, then China, by definition, will become the leader in artificial intelligence just because of the sheer volume of data that China will continue to produce. And I think, and I'm coming to the point of privacy, which is that probably data in China is probably more easily gotten than, maybe other places where privacy laws are less, stringent, more stringent, sorry. So I don't know. Maybe I want to talk about this issue of regulation / privacy in Southeast Asia. Is it more friendly, less friendly? Maybe Rajeev, do you have a view about this?
So I think it's one of the most topical elements of technology today is data integrity, privacy, and the regulatory response. I think to take a step back, I think every 10 years or so, society goes through a phase where there's evolution through capitalism, and that evolution creates some problem. 10 years ago, it was expressed through financial services, and then there was a necessary regulatory response. One of the challenges with the regulatory responses is it's often a pendulum, and you often over-regulate and switch to the other side and curb innovation and growth. and that's a consequence to that regulatory response. I think in Asia, it's even more challenged because the biggest issue with data is really data sovereignty. So we, as a firm, are one of the largest owners of, I think we're the largest private owner of data centers in the world today. And one of the most important issues for a lot of our tenants is the sovereignty of the data. Even though, for example, in Facebook's case, it could be 50, 60, 70% cheaper to have a 50 megawatt facility in Bintan. They would rather spend double the amount of money and have that jurisdictionally here in Singapore, because there is a lot of perceived or realized risk associated with the integrity and sovereignty of data. And I think that's going to be the single most important challenge for entrepreneurs, for infrastructure companies like Alibaba, Tencent, Facebook, Google, Microsoft, because data is the single most important strategic asset for every corporate today. And so I think the regulatory response is rife with execution risk. And if I was a betting person, I'm sure they will mess it up. But I will say that there's a lot of rhetoric in the press today around what people should or should not be giving up. We're fortunate to have some exposure in studies through social media companies, and what we often see almost universally is most young people today have come to the determination that the net benefit of what they give up is more than zero, meaning they get more than they give up from a privacy perspective. And therefore it tells us that this is not going away. This is here to stay, and the regulators need to find an equilibrium that's an appropriate response as opposed to an extreme response.
Okay, well, so that's some good feedback that the MAS, for those of you out there with the MAS, you can take that into account. Now, I've only got, was it 9 minutes? Oh, 9 minutes, okay, good. A little bit more time. So maybe switch gears a little bit. I'm sure we have entrepreneurs here in the audience, and you guys have done a good job in talking about some of the opportunities, some of the challenges, right? If you're an entrepreneur, you have to take into account when you are building your company for acquisition or for an IPO, right? Or which sectors to focus on and which countries to focus on. Maybe if I can get each of you to just kind of give some feedback to the entrepreneurs who are watching us. What traits do you look for in an entrepreneur? What kind of advice can you give an entrepreneur? Maybe an entrepreneur that is more Southeast Asia based than an entrepreneur in Silicon Valley. I mean, is there a difference? Probably some things are different and some things are not. Maybe I can start with you, Meng.
Sure. I think integrity is the given, so I wouldn't even go there. Without that, there's no starting point. But in addition, I look for 3 more things. Number 1 is the past track record of success. I want to know what other ventures have you started and what have you achieved with it. Number 1. Number 2 is the alignment of interest with the investors. So have you got enough skin in the game? Are there distractions? Do you have other businesses that could compete with this business or distract you from this business? And number 3 is that I look for entrepreneurs who can form and retain a professional management team. For 2 reasons. The business environment is getting more complicated, competitive dynamics getting more intense. So no one can do it alone. We all need a strong team, right? And number 2 reasons why I put emphasis on the professional team is that, A+ people will never work for a B manager. By looking at the quality of your team, I kind of know the quality of the founder.
Okay. Rajeev?
Nothing I'm going to say here is earth-shattering. You can read about what investors look for in founders. But I think for us, I would concur with what Meng said. I think we don't just look for people with successful track records. What I think is sometimes lacking here in Southeast Asia is celebrating failure, if I can be frank. And so we also look at when people have not done so well and how they've picked themselves up, dusted themselves off, and gone on to the new venture. And the lessons learned from those experiences can be incredibly beneficial to their new startup. So that's one thing we look for. We like to see continuity in founder-led businesses. So what we don't like to see is where the founder at some point in the funding cycle becomes the chairman or someone more ceremonial, and where they're not really in the weeds or in the detail. I know sometimes that sounds counterintuitive to scale, but in almost every experience from an investment perspective, we have found founder-led businesses to be the most successful ones because they have the conviction, the dedication, the insight to make very difficult decisions. And that's not always the case for people that are operating the company who make more risk management decisions. I think we're very focused on founders that are absolutely maniacal about their product, and particularly folks that understand how to pivot from products to platforms successfully. And then I think the last thing that we look for is, and this is a more nuanced point, but particularly in Southeast Asia, there's always a spectrum of balance between businesses that need to hyperscale or blitzscale, as our good friend Reid Hoffman from LinkedIn and Greylock wrote about recently, and that balance between hyperscaling and capital efficiency. And we find that the best founders are the ones that can figure out where they need to play amongst that spectrum between hyperscaling and spending at all costs to conquer market share in a winner-takes-all environment versus being incredibly focused on unit economics and efficiency of every dollar invested.
Okay, but let me make this a little bit more complicated for you. The last time the Nasdaq was the last time the Nasdaq was high was back in 2000, right? For those of you who, I think most of the folks here would probably be in primary school or something. But back in 2000, in March 2000, the Nasdaq dropped, I don't know, over a span of 6 months, dropped by 40% or something, right? I remember I was around because I'm old enough, and I remember a lot of folks in Singapore had a lot of startups, and then the market corrected, right? And so the question the advice you would give to an entrepreneur today is that today we are seeing the Nasdaq at all-time high, right? The number of companies out there also all-time high. We're in this conference, which is probably the biggest conference that Singapore has put up, MAS has put up since for a long time. What happens when the market corrects? What should an entrepreneur do, right? On what basis would he decide to continue, stay the course, hang on tight, or give up? If you're an entrepreneur and that situation happened, over the next 6 months, what would you do? Maybe Kenny, you can go first. It's not in the script. Sorry about that.
I guess this could have been part of the answer to your last question too. So like, what's in an entrepreneur that we kind of look for? I think in difficult times, right? You really have to understand what issue or what problem you're really solving, and be laser focused on doing that, right? Because I think a lot of people try to do too many different things at a time, and just spreading themselves too thin, and that a lot of time would not end up in a way that, especially when external conditions are difficult, that is also very that's very dangerous, right? So so I think having the focus on what you do, what's the issue that you want to solve, and sort of making sure that you have the skills and the people to help you solve the issue, I think is sort of the number one thing that entrepreneurs need to focus on.
Guys, any comments on that point?
Well, I hope that the entrepreneurs have, before the crisis hit or before the market correction hit, you are well funded. But more importantly, you have chosen good investors that could stay the course with you, and investors who could continue to believe in your business and continue to fund you. I think that's very, very important. And secondly, I would say that you have to accelerate your time to profitability and try to minimize cash burns and so on.
Rajeev.
I mean, the only other thing I would say is if you see the writing on the wall, fail quickly and move on. Refine, iterate, don't wait too long, don't go into ICU and pump yourself up with morphine and dilute capital even more. If your business is really struggling, have difficult conversations up front. There is a fair fight to fight, but if that fight's not fightable, then it makes sense to close up.
Great. Well, thank you so much. I think we're down to our last minute. I just wanted to say that for you entrepreneurs out there, it's very commendable. I think what you're doing. I think Meng mentioned, right, that one of the challenges of Southeast Asia is actually entrepreneurs and the perception of entrepreneurs. So the fact that you're starting something and you want to be your own boss and maybe try to change the world is a very commendable one. But be prepared for the hard times, right? And raising a little bit more money is always good. So with that, we've reached the end of our discussion. Thank you so much, panel. And please, audience, please join me in thanking our panelists for the discussion.
Thank you very much, John. Thank you.